Hey everyone, welcome back to Corporate Dakota, the place where we break down the confusing world of business and finance, and sometimes presidents get nice bonuses for doing their job. Data today, we're diving into Carisma Therapeutics Inc. and their latest report, which is full of interesting news about big money deals and changes at the very top of the company. Stick around to see what this means for their future, and remember, if you like getting these clear explanations, don't forget to subscribe and join our Discord community for more insights linked down below. So what we have here is a Form 8K filing. Think of this as a way for companies to quickly tell the public about major events that happen between their regular reports. It's like a news alert from the company itself. Carisma is telling us about some important stuff that happened around late August 2025. Carisma Therapeutics is a company that works in health. They are involved in developing new treatments. But like many companies in this space, they often need to raise money to keep their research going and bring their products to market. This filing is mostly about how they plan to get that funding and what it means for their leadership. They're reporting on a big financial agreement. It's called a merger agreement, which means Carisma is planning to join up with another company or at least acquire part of it through a merger. As part of this plan, they're also looking to bring in a significant amount of cash. They're aiming to get at least $25 million. This is crucial for companies like Carisma because research and development in the biotech field requires a lot of money. Without this kind of funding, even the most promising ideas can't move forward. A big part of this new money comes from a company called Accession. Carisma has signed a deal specifically with Accession to get $5 million. This is called a private placement, meaning they are selling shares directly to Accession, not to the general public in a typical stock offering. The exact price for these shares isn't set yet, but will be figured out based on the company's overall value after the merger. This shows Accession believes in what Carisma is doing and is willing to invest. To help make this deal happen, Carisma has hired financial advisors, Chardin Capital Markets and Lake Street Capital Markets. Think of them as matchmakers for big financial deals, helping to connect companies and investors and making sure everything is handled properly. They are getting paid to make this happen. After this investment, Carisma also plans to sign an agreement with the investors, including Accession. This is called a registration rights agreement. Essentially, it means Carisma will help these investors sell their shares later if they want to, by registering them properly with the government authorities. This is standard practice when private companies sell shares to investors. Now let's talk about how they're selling these shares. They're saying this sale to Accession is exempt from the usual public filing requirements under a specific part of the law called Section 4A(2). This is often used for private sales to sophisticated investors who they believe can protect themselves without public disclosures. Accession has confirmed they are a well-established investor and are buying these shares to keep them and not to immediately resell them. This is important because it suggests Accession is in this for the long haul, seeing value in Carisma's future. This part is all about changes in leadership and who is getting paid what. When major events like mergers happen, companies often adjust their executive contracts to make sure key people stick around and are motivated. Carisma has updated the employment agreement for their president and chief executive officer, Stephen Kelly. This new agreement is effective if and when the merger goes through. While many of the details are similar to his old contract, there are a couple of key changes. First, it acknowledges his current salary, which was set after their annual pay review. Second, and this is important, the merger itself won't be considered a change in control of the company under his new agreement. This can sometimes trigger payouts or other benefits, so they're clarifying that won't happen here. The most significant change for Mr. Kelly is that he's going to be granted stock options. These options will give him the right to buy a certain number of Carisma's shares in the future, specifically 4% of all the company's shares once the merger is complete, assuming all the existing options are used. The price he'll pay for these shares will be based on the company's stock price on the day he receives the options. These options will be earned over 3 years, with parts of them becoming available each year he stays with the company. This is a common way to incentivize top executives to stay and help the company grow, especially during times of change like a merger. On top of the updated employment agreement, Mr. Kelly is also getting a special bonus agreement. This agreement is tied to the success of the merger. If he stays with the company until the merger is completed, or at least until October 2025, he will receive a retention bonus. This bonus is calculated based on his salary and a percentage of his annual bonus, prorated up to the date he qualifies. There's also a separate transaction bonus. If the merger happens before October 2025, he gets an additional bonus. This bonus is calculated as a higher amount based on his salary and bonuses. minus the retention bonus he already qualified for. Essentially, it's a reward for staying through the whole merger process and making it happen successfully. These bonuses are designed to keep key leadership focused and committed during a critical period for the company. This section is about something that could impact whether the company stays listed on the stock market. Carisma's stock was moved to a market called the Nasdaq Capital Market, which is generally for smaller companies. They were given a deadline, initially October 7, 2025, to meet certain listing requirements, including having a stock price of at least $1 for 10 consecutive days. Now, it seems they needed a bit more time. They asked the Nasdaq hearings panel for an extension, and the panel agreed to push the deadline for meeting the $1 per share requirement to October 21st. However, there's a catch. They still need to complete their merger by the original October 7th deadline, and before that merger closes, they need to show a stock price of at least $4. This means they need to not only get the merger done, but also significantly increase their stock price in a relatively short period. There's no guarantee they'll meet these conditions. This part just lists all the official documents that come with this filing. Most importantly, it points to the actual paperwork for Mr. Kelly's updated employment agreement and his bonus agreement, which are key exhibits showing the details of those executive compensation changes. Finally, we always see this section in these reports. It's called the cautionary note on forward-looking statements. Basically, the company is telling us that when they talk about future plans like closing deals or expected outcomes, these are just their current hopes and expectations. Things might not turn out exactly as they planned because of risks and uncertainties. They're warning us not to fully trust these future predictions because real-world events can definitely change things. They mention all sorts of risks, from not getting approvals for their deals to issues with their research and development. It's a standard legal disclaimer to protect themselves. And towards the end, they also include a note that this report isn't trying to get anyone to vote a certain many shares. They're pointing people to other official documents, like a registration statement called Form S4, where all the detailed information for investors voting on the merger will be. They emphasize that investors should read all these documents carefully to make informed decisions. Overall, Carisma Therapeutics is in the middle of trying to secure significant funding and merge with another company. The deals they're making are crucial for their survival and future growth, but they also come with clear challenges, especially around meeting Nasdaq's listing requirements. The executive compensation changes are aimed at keeping their leadership team focused and incentivized through this period of significant change. It's a high-stakes situation for Carisma, where the success of these upcoming transactions will likely determine their path forward. Now, looking at Carisma's situation from a wider perspective, they are acting quite aggressively to secure their future. Landing a strategic investment from Alpugen and pursuing a merger are strong moves that indicate a clear strategy to either grow or be acquired in a way that benefits them. However, the tight deadlines from Nasdaq are a significant red flag. Companies often seek extensions, but failing to meet its stock much harder to trade. The fact that they need to achieve a 4 points area bid price before the merger, while also completing the merger by October 7th, suggests they are under considerable pressure. This means the company's direction is heavily dependent on the successful interimly execution of both the merger and the successful increase in their stock price. The risks are tangible here. It's not just about getting a deal done, but about meeting strict external benchmarks. What do you think about Carisma's situation? Are they making the right moves to survive and thrive, or are the Nasdaq requirements too big of a hurdle to overcome? Let me know your thoughts in the comments below. If this breakdown was helpful, please hit that like button and subscribe for more deep dives into corporate filings. And don't forget to check out our Discord community. Thanks for watching. See you next time.